So I welcome you to the second talk in our seminar series, Energy and Finance of the House of Energy Markets and Finance this year, this term. And in the last talk, we learned a lot about carbon risk. And today we have a very well-known presenter in the field of energy finance. So he is David Wozabal. He is a professor at the Technical University of Munich. Basically almost for all aspects around energy finance. So I think officially for investment, finance, and risk management in energy markets. So he is an expert in this field, and today present very recent research on algorithmic trading in electricity markets, in short-term electricity markets, to be precise. And we are very much looking forward to your presentation. We see already the title, Algorithmic Power Trading, Challenges and Weather-Based Strategies. The floor is yours, and we are happy to have you here.
Thank you for this introduction, and thank you to the organizers for inviting me to give this talk today. And so I want to basically talk about my recent work in let's call it algorithmic trading, or kind of decision making for actors that trade on short-term electricity markets. And the work that I will be presenting here today is joint work with Thomas Kupelwieser, who is a PhD student, who's also, I think, in the call. So if there are any tricky questions, I will refer it to him, and my long-term co-author, Nils Löndorf, who is at the University of Luxembourg. So sorry to switch here. My program for today is basically these 3 points that I want to discuss. So first, I want to talk a little bit about the trading problem when you consider day-ahead and intraday market bidding combined, and the question to what extent you have to coordinate the trading decisions on the day-ahead and on the intraday market. In particular, to what extent you have to anticipate intraday trading when you make bids on the day-ahead market. The second part is, I would say, the main part of this presentation. It's contained in the paper that I would say got me invited to give this talk. This is weather-based trading strategies on intraday markets. So it's only considering intraday markets and strategies which are based on forecasts for renewable output. And the third topic is kind of an overarching theme for all of what I will be saying, which is the issue of liquidity, or the lack of liquidity in intraday markets, and how to deal with that and how it affects optimal decision making. If you want to read about all these results that I will be presenting, you can find them in these 3 papers. So the first one is the one about the value of coordination. The second one is the I would say main paper for today, which I wrote together with Thomas Kupelwieser, and the third paper is concerned with the with the issue of liquidity, and in particular the comparison between continuous trading and auction markets for the intraday market. Okay, so let's just start with a short motivation. So what I want to do here is to think about trading strategies or policies, so optimal decision making in trading on short-term electricity markets. And these decisions should be non-anticipative, which means that basically they should be implementable or based on only on information which is available at the time of decision making. And so that's a very broad goal. Let's just narrow this down a little. So for this talk, we will be considering only the kind of broadly the European market design. So a day-ahead market followed by intraday markets. So in particular, I will not be talking about any longer-term future markets like monthly, quarterly, or yearly futures. And I will also not be talking about reserve markets, which would, in principle, I think, qualify to be short-term markets, but I still kind of leave this topic out for today. And in the intraday market, I would lay a special focus on continuous intraday trading, which the European market design is converging to. And I think another important feature of all the work that I will be presenting today is that we are not so much interested in explaining market equilibria or strategic interaction between agents, but we take the perspective of a single agent which kind of faces the market as an exogenous reality and does not interact strategically. Although what I think is a realistic assumption which you'll have to make is that the actors on the market, they recognize that the market is not fully efficient, so that their actions have an impact on the price. So usually an adverse impact. So you want to sell, you drive the price down, and if you want to buy, you drive the price up, in particular in intraday trading. Okay, so this is roughly the setting. Let us just recapitulate a little bit what is the kind of this European market design with the day-ahead, intraday, and balancing market. So when we talk about the day-ahead market, we talk about a uniform price double auction, which takes place one day ahead of delivery. Then the continuous intraday market is a classical continuous market with an order book, which typically trades briefly before until briefly before the electricity goes into delivery. And the balancing market is also an auction market, which takes place one day before delivery, and you have this kind of complicated remuneration schemes where you get separate payments for power and energy. And then you have on the day of delivery, the call-offs by the TSO. But however, as I said before, we'll not look so much at the balancing market for today's presentation. I forgot to say actually in the beginning, and I think we had this discussion briefly. So if you feel that you have a question or you have a comment, you can interrupt me at any point in time. You don't have to hold off till the so to say question and answer session. So please feel free to interrupt. Okay, so coming back. So if you actually want to make a decision on trading, there are certain things which are special or which are complicating these decisions on electricity markets. So firstly, you face random future prices, which is not very special to electricity markets. Really, you face this in any market, actually. You also have random demands, which is also maybe not so special, but also random production, which is not, I think, a feature which is there in many other markets. Random production due to unforeseeable production from renewable sources of electricity. Secondly, you have a strong technical dimension. So hard technical constraints, in particular, that demands have to be fulfilled at any point in time, which forces a quite high temporal resolution. So you have many decisions to be taken in a kind of high temporal resolution. And since there is scarce, or there's hardly any electricity storage, it often helps to view electricity not so much as a commodity, but more as a service. So you trade some products, for example, for delivery in a certain, say, hour or quarter hour. And after the delivery of that, after this quarter hour is over, this hour is over, this product just ceases to exist. And the last point here that I wanted to mention is illiquid markets. So markets are often illiquid, in particular the intraday markets, as we will see in a minute. And all of this leads to a highly non-trivial setting. So it's quite, I feel, quite hard to really navigate all these short-term markets and make optimal decisions. And just as a kind of a minor fact, as this will not at all be the focus here, just as a fact which reflects that markets often do not reflect the true values of the commodity that is actually traded. Just consider this plot, which actually considers the Reber price, so the symmetric price for imbalance in Germany. This Reber price here is regressed on the ID1 intraday price, so the kind of volume-weighted average intraday price in the last hour of trading. And so if you look at the kind of this balancing phase as a spot market for electricity, and the ID1, so the intraday market, as the last possible future market, you would actually expect convergence of these prices. And therefore, you would expect that this regression yields a very good fit. But if you look at this plot, which is rather boring here, you see that this fit is actually very poor. So what does that mean? We have an R square here of below 20%, meaning that in some sense, you could interpret this as that market participants are not very good at guessing what the Reber price will be in the last hour of intraday trading. So which kind of illustrates that this is quite tricky environment for decision making. Okay, so let's talk a little bit about liquidity, since this is a main theme of this talk. So we have these two markets, the day-ahead market and the intraday market. And the day-ahead market, I would say liquidity is not a big issue because we have quite high volumes, and it's also an auction market. Means there's just one market clearing. All the demand and supply basically are matched at one point in time. This usually leads to quite a good and stable price signal and a high liquidity. And you also see, if you look at the volumes here, for example, in the German market, you see that the day-ahead volumes are actually an order of magnitude larger than the intraday volumes, although, of course, the intraday volumes have been increasing over the past years. And intraday trading, by contrast, has these smaller volumes, as I already mentioned, but it is also continuous trading. That means that these volumes are kind of spread out over the whole period of trading, which means that you actually face, in many times and many points of time, you face a rather illiquid market. And this leads to substantial liquidity costs for anybody who wants to trade on this market. So here's just one example of one market for one particular product, which is the 12th hour on the 12th of December. And you see here the bid-ask spread. So the best ask and the best bid here in blue and red over the whole period of trading. And you see that far from delivery, these are massive spreads. Okay, and even as you move close to delivery, you still have significant bid-ask spreads, especially, this is kind of interesting, also very close to gate closure. And if you compare that obviously to financial markets, you see that this is a very different situation. So here in admittedly a rather liquid share, you see that these bid-ask spreads are hardly existent. Okay, so it's both is continuous trading, but the electricity market is actually rather illiquid if you compare to financial markets. And if you try to kind of put your finger on liquidity costs, I can, or if you're interested in that topic, I recommend this this paper here, which is recently published in Energy Policy, where we try to actually measure liquidity cost as the cost of a round trip trades. So you buy a certain amount of electricity and sell it again. You will have paid some, or you will have lost some money in liquidity costs, and we measure how much that is. And these are some results from this paper. So what you see here for the German market even if you trade only very small amounts of electricity, so 0.1 megawatt hours, which is the smallest possible amount that you can trade, you see that in this time period, the average volume weighted cost of such a round trip is 2 euros per megawatt hour, and this goes up to nearly 4 euros for larger volumes. Okay, so you have kind of substantial cost in trading back and forth here. And this actually is a general feature of continuous trading. I don't want to go too much down this road, but this connects very well actually to a large section of the finance literature that is deeply suspicious about continuous trading. So I put here 3 papers, a book by Schwartz, a recent paper by Budish and Crampton, and a paper by Du and Su, and they all basically question a little bit the necessity for this kind of continuous market and the continuous market clearing in this order book fashion in the context of financial markets. And here I have a working paper of the Deutsche Börse Group, who actually propose a kind of frequent auction setting for a intraday electricity market. Okay, but so we are dealing with continuous markets nevertheless, even though they might have some issues with liquidity and maybe even with price discovery. And I want to therefore come to this first point on my introductory slide. So this day ahead and intraday coordination. So most traders on short-term electricity markets actually engage in trading in the day ahead market as well as in the intraday market. And of course, if you do that, you immediately can ask a few questions. So first of all, why do you need both markets? So why would you not exclusively trade on the day-ahead market? What's the advantage of the intraday market? Why would you not exclusively trade on the intraday market? And if you have to trade on both markets, why? Can you actually decide this independently? So can you first decide on your day-ahead market bids and then basically just wait what happens, look at the prices, and then go into the intraday market and see what options you have or what opportunities arises, and then just trade on the intraday market based on that. And in this paper here, which I wrote together with Nils Löndorf, which is actually a working paper, we investigate these 3 questions in the context of a trader who has an energy storage. Okay, and this paper has 2 parts to it. The first one, I actually will not talk in too much detail about this paper, but just give you a glimpse of the results, also motivating the main paper for this talk. So the first part of this paper is actually a stylized simple model, okay, where you can just see what kind of constitutes the attractiveness of either market and what are the trade-offs trading on either of them. So we make a few assumptions here. So we want to maximize our expected profits. Okay, so we have random prices here. So these are kind of, it's a stochastic optimization problem, if you will, and we want to maximize expected profits. We have essentially 2 time periods where electricity is delivered and 3 time periods where there are decisions. So in period 0, we bid on the day-ahead market for delivery in period 1 and 2. And then in period 1 and 2, we can trade on an intraday market, and we start with an empty storage and assume that we have a price response on the intraday market. And so that means our trades actually change the price, which is a linear price response, and no price response for the day-ahead market trading. And we also assume such an arbitrage relationship between the expected prices. So the expected intraday price is actually the day-ahead price. And if you make these assumptions, you can actually analyze this analytically. You can show a couple of things. I just summarize this in this one proposition, which basically analyzes the trade-offs between the 2 markets. So it says if intraday prices, which are random, have a higher, I would say, dispersion than the day-ahead market prices, then you can actually show that it is never optimal to use the full capacity of the storage on the day-ahead market. So you would always leave some capacity open for the intraday market, anticipating intraday trading. And you can also show conversely that there's always a beta bar, such that if the price response beta is between 0 and beta bar, so it's a small price response conceptually, then it is actually optimal to only trade on the intraday market. And if you look at kind of the mechanics of this, then you see that the attractiveness of the intraday market is basically the higher dispersion or volatility, which is of course good for storage if you have more price movement. And of course, the fact that you have a better information. So at the day-ahead market, you kind of you can bid both of these periods at once, and you in an intraday market, you already know one of those prices. You can already buy the first period knowing the price. And of course, the attractiveness of the day-ahead market is basically the market depth, or the fact that you don't have any liquidity costs. And you can already derive some kind of prescriptive results here. Namely that small and fast storages should rather focus on the intraday market, and larger storages should focus rather on the day-ahead market. However, there's always a value of coordination between the two markets. And so that's a kind of a qualitative result, if you will, and we try to quantify this in the second part of the paper, which is actually the main part, I would say, and which I will talk again only very shortly about. So there we set up a model, a stochastic optimization model, in order to quantify this value of coordination. So again, we have day-ahead trading and intraday trading. Intraday trading is done 24 times during the day. So in an hourly fashion, we have a kind of random price process, which we fit from order book data, and we calculate lower and upper bounds for the value of coordination. Okay, so using scenario trees, so we have a special way of constructing these scenario trees so that we can ensure that we get lower bounds, and we have a kind of information relaxation scheme which yields us upper bounds. And we look at three types of assets. So a very small battery storage, it's actually not very small, but a small battery storage, which is kind of a 1 hour storage. So it has 10 megawatt of power capacity and 10 megawatt hours of energy capacity, and a quite high efficiency of 95%. A pumped hydro storage, which is an 8 hour storage and with an efficiency of 75%. So this is basically the type of storage which kind of accompanies the kind of German nuclear plants. You have many storages that are have these specifications and are pumped hydro storages. And then a classical seasonal hydro storage, which you would find in the Alps, where you have maybe sometimes rather small turbines, often no pumps, and you have some kind of an inflow of water, which we model here as a continuous inflow. And equipped with this setting, we can now calculate basically or kind of quantify the value of coordination between these two markets. So what you see here is intraday only bidding. Sequential bidding means there is no coordination. You just do optimal day-ahead bids first. And then you just basically roll along through this intraday market, and you see if you can pick up some opportunities. And here is this coordinated bidding. And what you can see here is actually quite interesting. So you see that the pumped hydro storage actually profits a lot from this coordination. So something between like 30% here and maybe 10% here. Whereas these small battery storage and the reservoir, they also have a positive value of coordination, but it's much smaller. And in particular, the battery, and that's kind of in line with the results from the first part of the paper, has most of its revenues actually in intraday trading, so also in the coordinated strategy. And the large reservoir earns most of the money on the day ahead market. So you could say the battery could also just trade on the intraday market, and the reservoir would actually lose something, but not too much, just focusing on the day ahead market. Okay, so you have the most gains here in this pumped hydro reservoir, which is kind of in the middle of the two. Okay, so that's basically saying that if you have a short-term bidding strategy, you bid on day ahead and intraday market, you should in principle coordinate these decisions if you want to make optimal decisions. So, however, there's a problem with all of this layout of this paper, and it is basically a computational problem. So what we did here is we set up a large stochastic optimization problem, which has 25 stages, and you can maybe extend this a little bit, and you can maybe make 48 or whatever amount of stages, but then you quite quickly hit a limit. There's a limit of finding the globally optimal strategies here, and it's particularly hard because of the intraday market. So what we did here is we had hourly trading decisions for the intraday market. So basically what this is a single buy or sell decision every hour for a random price. So that's actually what most people do that do optimal decision making for intraday trading. However, that's not really how the intraday market works. The intraday market is basically a continuous trading market, which is based on a order book. So we have much kind of shorter time scales. These order book dynamics evolve on a millisecond level, basically. Also, the changes happen at some point in time. You cannot kind of put a discrete time grid over that. And of course, you have the whole order book. So it's not just the price, but you have actually bid and offer curves. So that means if you use such a model as I presented just now, the decisions that you get out of this model, they cannot be immediately used or given to a trader or given to a maybe even directly submitted to the exchange, because they don't take into account the fundamental realities of this market. So you actually need another layer of modeling, or even another layer of, maybe more generally speaking, of decision making on top of such a model. Okay, and that's actually common to many models that you see in the literature about decision making on the intraday market. So this kind of discretization of time and looking at average prices is quite common. So let's just look at how it actually works. I think most of you will know, but it's still a kind of instructive to look at continuous trading and how it differs from this more stylized way of looking at it. So what we have at any point in time, say T1, we have orders in the order book, and you have a buy stack and a sell stack. I should probably have named it rather offer and bid and offer stack. And here you see the best sell order, and here you see the best buy order, and in between this is the bid-ask spread. Okay, so this is point t equal to 1. So now at point t equal to 2, which is completely random in some sense, a new limit order might be put into the order book. Say it's a new order that wants to buy 29 megawatt of electricity, say for 1 hour, and bids 50 euros for that. Okay, so what happens? So conceptually, I just put this like sequentially, but this all happens at point t equal to 2 instantaneously. The exchange would clear this order first with the best available sell order, which is this one, 37 euros, 22 megawatts. This is not enough, so this is only 22 megawatts, but this is here for 29 megawatts. So the remaining 7 megawatts would be cleared against the next best order, which is 45 euros. Okay, and this is then enough. So this is a for 12 megawatts, and then in the end, you will come to a new state of the order book, which looks like that. And you will see a price tick, and this price tick will be 45 euros. Okay, but you already see that even the price tick, so even if you go to tick level data, does not reflect the full reality of this trade. So it's 45 euros is the price tick, but the person who actually bought the electricity didn't buy it for 45 euros, but for some average between 45 and 37, actually closer to 37. Okay, so if you want to actually have a trading strategy which really accounts for that reality, you will have to work with order book data. So that's and that's basically our goal. So we want a a non-anticipative trading strategy for intraday only arbitrage trading. Okay. And so I already talked about non-anticipative and intraday only this time, so we don't consider the day-ahead market at all. Although we already know from the last paper, actually we should, except we have a very specific asset. And we do arbitrage trading. Obviously, we don't. So what I mean by that is not arbitrage in the strict kind of financial sense, like making money out of nothing, but rather what I mean is that we have no assets. Okay, so I consider now trading without any demand and without no production assets. Okay. And the goal here is to actually take into account all this order level data, so take into account the complete order book in our strategy. And at the same time, of course, we want a policy or a trading strategy which should be computationally tractable. So we should be able to, in a short time, come up with a implementable trading decision. And of course, ideally, we also want to make a profit. So just by kind of trading, buying and selling, we want to make positive out-of-sample profits. And out-of-sample emphasizes, again, that the strategy should be non-anticipative. So we kind of train the strategy on a training data set, and then we test it on another set of data. Okay, and that's basically the paper that I will present for the rest of the talk, which is together with Thomas Cooperwiese again. Okay, so let's have a look at the literature. So I will not even attempt to give a comprehensive literature survey here. So, but I just say that most papers that actually propose intraday trading strategies actually consider asset-backed trading. So they consider the situation of somebody who has a power plant or has to fulfill a demand or something like that. The second feature which distinguishes us from, again, most of the literature is that most papers do not consider this exact order book dynamics, but they do what I presented before for the first paper. So they have this kind of discrete time, kind of average price view on the intraday market. And there is actually one notable exception, which is a paper by Gilles Bertrand and Anthony Papavasiliou, which recently appeared in the IEEE transactions on power systems. So they actually do that. So they look at the order book data and kind of train a strategy for a storage, I believe. And then here I put some related literature. So this literature is related either in the sense that it is concerned with this kind of arbitrage trading, okay, or that it kind of considers this order level data. And again, I will not go discuss this in detail. Just want to mention that there are a lot of authors from Duisburg-Essen here on this slide, and that's not just because I'm presenting here, but it's because it's actually an impressive number of papers on that topic coming out of this university. Okay, so let's just take a sidestep for a moment and look at, so we actually want to have, in some sense, an algorithmic trading strategy. We also want it to be fast. So we are kind of close to high frequency trading or algorithmic high frequency trading, which is, of course, a big thing in financial markets. And so let's just look at the realities there. And this basically follows the paper by Budish and Crampton, which is a very nice read. I can recommend it to anybody. And so the idea there often is that these algorithmic traders, they typically wait for some kind of a signal which indicates a change in value of, in the fundamental value of an asset. And there often actually it's not so much about the skill of evaluating the signal, but rather about this how fast you can react to the signal. So typically or often it's like this, that all of the proceeds or most of the proceeds of such a signal go just to the fastest trader or to the fastest trader. So Budish and Crampton also call this the arms race for speed. And a very nice example of that is actually the kind of locational arbitrage, if you will, between the two largest stock exchanges in the US, which is New York and Chicago. So they, the idea here is they trade the same assets essentially. And if you observe a price change in one of them, this is a signal for the other one. So typically Chicago is faster, so they kind of process information faster, and New York follows. Okay, so what you can do is you can observe prices in Chicago and then trade accordingly in New York. And for that, you'll have to transmit this order or the signal between these two places. And if you look at the kind of classical telecommunication line between New York and Chicago, so the internet connection, if you will, then you find that this is, of course, not a straight connection, but it kind of goes through all the kind of population centers, and you will end up with a ping time of 16 milliseconds. That doesn't sound so bad, but it turns out that actually there is a company which is called Spread Networks, which decreased this ping time to 13 milliseconds just by building a more straight cable between these two cities or between these two exchanges, spent 300 million euros for doing so. And what they achieved is a reduction by 3 milliseconds, which does not sound very impressive on the first glance, but in reality, it was very successful economically. So all the traders actually had to buy subscriptions from Spread Networks if they wanted to make money from high frequency trading. And since then, this has continued. So people have been constructing microwave towers, kind of transmitting signals as microwaves, because air seems to be a better or a faster conductor, closer to the speed of light in a vacuum. And the actual speed limit is exactly that, the speed of light in a vacuum, which would be 4 milliseconds for a transmission of a signal between these two exchanges. So you see, it is very much about speed here, and this is not just the ping time, but it's also other areas like how fast you can process the signal and ping times within exchanges. And this actually generates a lot of earnings for people who, this type of trading, for people who specialize in that. So just the arbitrage for one particular pair of instruments is estimated to generate $75 million per year. Okay, and what is usually done here is that you have, let's just go back to our picture, is you have this kind of continuous trading, and you have some fundamental value. Okay, let's just assume again, this is just a mid price here at 36 euros, and just assume that you observe a signal which changes this fundamental value upwards, significantly upwards in this particular instance, to say 75 euros per megawatt, which would of course mean that these two buy orders, they are in some sense kind of outdated. So people would like to actually kind of take away these orders from the exchanges. So that means that these orders are actually stale in that sense. And if you are quick enough, but you will be quicker than the people that actually place that orders, and you will what is called snipe these stale quotes, and you can buy cheap and then later sell it off again close to, say, the fundamental values and generate some profit. Okay, so this is the idea in the financial world. So I think we are far away from the required liquidity that you need for such strategies. And so our idea is similar in some sense, but it is still different in many crucial aspects. So what is our trading strategy actually doing? So what is the intuition? So the intuition is basically that you have a market where you have a significant fraction of renewable energy. So just take Germany, for example. And we assume that a large fraction of the renewable energy producers actually trade on the day-ahead markets based on their forecasts what production will be. And these are, of course, based on weather forecasts. And this, but in particular, means that if there is a forecast error, and this forecast error is noticed before delivery, then this would cause a supply or demand shock, which would again then in turn cause a price shift in the intraday market. So this is the intuition, and this intuition is also backed by recent literature. So you can see that, of course, kind of renewables kind of driving or are influential factor for intraday prices. So our idea is therefore to basically use a superior forecast of the day-ahead forecast error to anticipate price changes on the intraday market. Okay, and superior here means a mix of early forecasts, you want to be the first to know, but also accurate, of course. Okay, so that's the goal, or that's how the strategy supposedly works. So just a few words on weather forecasting. Actually, I should speed up a little, I see. So traditional weather forecasting is actually quite a quite slow business in some sense. So you have these large computationally intensive weather models, which also depend on expensive data, satellite images, weather balloons, and you get very few updates, so 4 to 6 updates a day. And however, recently, of course, due to the emergence of renewable power, there have been quite a lot of innovative companies that specialize in forecasting certain aspects of the weather which are important for renewable power production. So in particular, wind speeds and cloud cover. And we actually, as we just named a few here, we cooperated with Meteorologica for the particular project that I will be presenting. It's a Spanish company which has quite good forecasts for Europe in particular. Here you see kind of give you a glance of this forecast, or rather the forecast errors. So we have here the day-ahead forecasts, errors, the errors with an offset of 8 hours before delivery, 5 hours, 3 hours, and what is called the best intraday forecast, which is quite close to delivery. So what you see here is that obviously for both hourly and quarter-hourly production, these forecasts get progressively better as you move towards delivery. Yeah, so that's basically the basis for our policy, which I hope to have summarized in this picture here. So it's a very simple parametric policy. In some sense, the simplest thing that you can do if you take a weather-based policy. So what you see here is one of the cases. So what we do here is we have a time period T1 to T2, which we use to build up a position. So T1 is the time that we get the weather forecast. And then we just take some time till T2 to build up the position. So in this case, we actually would buy electricity up to a maximum level of V. Then we hold the position for a while, and then we sell it off again in the interval T3 to T4. Then there is a gate closure, and delivery is actually at T, or starts at T. And all of this is based on our signal, which is the forecast error. So this is the day-ahead forecast for the product T, and this is the forecast S hours before T. Okay. Okay, so and then basically what we have to decide on is this timing for one, and these quantities V, and we also define some thresholds for the required signal strength to make a trade. So we'll always, of course, epsilon will never be 0, but we would want to have a signal of a certain strength to actually base a trade on it. So we say that we have this delta plus and delta minus, and if epsilon here is larger than delta plus, then that means there is a shortage. We forecast a shortage in renewable production. That means we try to buy. It means we anticipate a price rise. This means we try to buy electricity early and then sell it off in the second time interval. And likewise for the other case. Okay. So then the only thing that is left to specify here is how to trade. So actually, if you have a continuous intraday market, or any continuous market for that matter, you have two ways of trading. Either you can accept existing limit orders, or you can place your own. We go for the second option here, and we have two strategies. One which uses limit orders and one which uses market orders. And the first one, we term the impatient strategy, which uses market orders. So this strategy builds up a position in this interval T1, T2 using an immediate or cancel market order. That means it puts a market order, so that means buys the quantity V for whatever price. And if it exhausts the whole order book, that it buys what it can and cancels the rest. So we might end up with a little less quantity than V. And then we unwind the position in the same way. And if we cannot unwind it completely, we clear the imbalance on the balancing market. We have to pay for the rebar price. Our second strategy uses actually limit orders. So here we it's a little bit more complicated. So we start trading at T1 and we build up a position by placing limit orders at the respective top of the bid and offer stacks. So if you want to buy, we just put the best buy order into the system and just wait till it gets accepted. And we also make sure that our order remains at the top. So we just change the price if necessary, and then trade until we have procured or sold a quantity V, and we then do the reverse in this time interval T3 and T4. And if we could not completely get rid of our position, we again use an immediate or cancel market order at T4 for the remaining position. And if there is still a remaining position, we clear the imbalance for the rebar price. So that's the strategy. To actually implement that, or to actually come to a prescriptive strategy, we have to still choose these parameters. In particular, we have to choose the time points and these parameters V and delta. And we do this again in a rather simplistic way. So we fix the timing beforehand. So we choose the 8-hour forecast that we have. So T1 is T minus 8 hours. Okay. So this, on the one hand side, allows us to kind of react quite early to a forecast, or to a forecast error. And secondly, it allows us to choose this interval T1, T2 rather long. So we choose T2 to be T minus 3 hours. So that means 5 hours to build up the position. And that's also not so bad, because if you remember this plot before, 8 to whatever, say 3 hours, we have before delivery, we still have kind of a limited liquidity. So it's good to have a little bit longer to build up the position. And then correspondingly, T3 to T4, we choose as a rather short interval because we have more liquidity in this time. So T minus 65 minutes, T minus 35 minutes. And to choose the parameters V and delta, so V plus, V minus, delta plus, and delta minus, we basically use a simple grid search. So we use basically a historical training data, so a certain number of days, and then kind of have a discrete policy space. So we have a finite number of possibilities for the thresholds delta and a finite number of possibilities for the quantities that you want to trade. And then we just look at in our training data set, which of these parameter combination gives us the highest profit here. So this is the sum of the profits in the trading days. D here in this training data set, which gives us the highest profits over our during our training period. Okay, now we have two evaluations. One is an in-sample evaluation, one is an out-of-sample evaluation. So in the in-sample evaluation, actually we have 1.5 years of training data. So this is the June 2017 till the end of 2018. Which is a substantial amount of data. So it's 58.6 billion orders for the hourly products, 131 million orders for the quarter-hourly products. So that's not something that a modern computer cannot handle. However, you have to think a little bit how to kind of organize the computations. Otherwise, this will be take a very long time. We also, for the in-sample evaluation, take the evaluation period as D1, okay? And we choose one set of parameters for the whole period and evaluate our trading strategy in a detailed manner against the order book data from the EPEX for the German market, I should say. We also take transaction costs into account and kind of check that this order to trade ratio, which should actually stay below 100, is not violated. And we use two forecasts here. So I said we base this on the 8-hour forecast, our strategy. And we trade 8 hours before delivery, and we also do that, but we additionally use the signal epsilon 0t, which is actually a completely accurate forecast. So this is basically trying to assess what could you earn, would you have a perfect weather forecast, okay, which gives kind of the potential for improvements in that area. And of course, we test the patient and impatient strategy both, and here you see the results. So I want to just point out three things here. So first of all, so here you see this kind of perfect forecast in the first panel, the true 8-hour forecast, patient impatient strategy, and both directions of trading here in this kind of vertical columns. And what you see is immediately that basically this impatient strategy doesn't work. Okay, so just doing this based on market or trading based on markets orders just either produces very small profits or even losses. Okay, all through all of the combinations here. So that's the first thing. Secondly, if you have a perfect forecast, you can earn something like 5 to 10 times more than if you have an actual forecast or a signal based on an actual forecast. So which kind of gives you the kind of potential for the value of a better forecast. And thirdly, the quarter-hourly products permit less volume. So you see here also the optimal decision. So if you look at the quarter-hourly products, for example, here it's only 10 megawatt hours that get traded versus here it's 300 for the hourly products. And correspondingly, they also generate less profit overall, although there are, of course, 4 times more quarter-hourly products than hourly products. Let's look at the optimal decision. So the parameters, the thresholds and the volume parameters here. So what you see here, this is for the optimal, for the completely accurate forecast here, you see that these signals actually have a very high quality, especially for hourly trading. That means you have a nearly linear increase in profit for higher volumes. Okay, so the optimal choice is always this kind of triangle. Only if you already act on very weak signals, or on very small signals, you kind of have this dip here at the end. Okay, on very small kind of forecast errors. And for the quarter hourly products, you see that this dip comes much earlier. So because we have much less volatility, so you can trade much less. And you see actually a similar picture for the actual forecast. So this is just about a kind of a lower quality signal. So this dip comes earlier, and especially if you choose this threshold small, you quickly kind of go into the zone where you actually make a loss with the strategy. So you have to choose decently high thresholds to make profits. And again, for the quarter hourly products, much less volume is possible here. Okay, so and now I'll talk about the out of sample study. So this was in sample. In some sense, this is not an implementable policy, but because you have to already have seen the whole result of the market to be able to implement it. So we want to do this out of sample. For that, we take the evaluation period to be the year 2018. And again, we look at these two types of signals based on the actual forecast and on the perfect forecast. We only look at the patient strategy because the inpatient strategy didn't work very well in the in-sample tests. And we have a rolling window setting. That means to actually, we do this grid search always based on the last 180 days of data. So we take 180 days, the 180 most recent days of past trading data, we calibrate our strategy to this grid search for this one particular day. We evaluate the gains from the strategy. On the next day, we do the same thing again, just rolling over, getting one more day of trading and putting one more day at the beginning of the window out. Okay. So let's just look at the results. So here you see the hourly products. In the first panel here are the cumulative profits. So you again see, so you again have these two types of forecasts, and you again see that you have this like one order of magnitude higher profits for if you had a perfect weather forecast, which you see here on this alternative axis, alternative y-axis. You also see that if you trade on the actual forecast, you have a very high volatility in some sense. Okay, so you have many days where you also have losses, and you have to trade a while in some sense to get a kind of stable result that this actually yields positive profits. You have quite high volumes, like 200 megawatts in either direction. So this is, you see in the second panel, sometimes a little less, seems to be also seasonal. And also the value of open positions is roughly like 20,000 euros plus or minus. So this is in some sense what you, the capital which you have to reserve if you want to engage in this type of trading. And you also see that there are just a few instances where there is balancing on the actual balancing market. So something has to be paid or received from for rebar prices. Okay. So these are the hourly products. Let's just look at the same thing for the quarter hourly products, which looks very similar. Everything is a little less. So we have smaller volumes, smaller open positions, and also the value of the open positions correspondingly is quite small. Maybe also interesting here is that we have, because these positions are rather small, we have much less kind of volatility in some sense, or even risk if you want to say it like that, in the quarter hourly strategy. Okay, which brings me to my last result slide, which is basically the kind of the statistics out of which goes along with the plots that I've shown here. So I just want to point out a few points here. So first of all, that the profits, which you already saw, are positive. Balancing costs are rather small as compared to the profit, so it's kind of doesn't play a big role. If you ask the question whether this is statistically significant, also significantly large, also positive profits, then the answer is yes. On the 5% quantile, all of these are statistically significantly positive. If you look at the quantiles, you see that you have a kind of a wider spread actually for the perfect forecast and for the hourly product. So this is also what we saw in the plot. So here you have actually quite little variation in the daily profits. And if you look at how many of these products are actually traded, then you see that for the hourly products, at least for the actual forecast, it's rather it's roughly a quarter of the products. Okay, so we have these thresholds, which means that if the signal is too weak, we would not trade. And so that's basically saying that in like 1/4 or a little more than 1/4 of the hours, you would actually trade. Here it's more like 2/3 for the quarter hourly products. And but this generates a quite significant amount of trades, or rather I should say interactions with the exchange. So many of them will be just price changes. Okay. Okay, so I'm at the end of my time, so I briefly conclude. So I talked about the coordination between day ahead and intraday markets, which is in principle an optimal thing to do. However, if you consider this whole sequence of decisions, it's very hard to find really optimal decision in the sense of stochastic optimization. In particular, the intraday decisions make this hard. And if you look at the intraday trading strategies, which I've been discussing for most of the talk, what you see is that you can use weather-based information to make a profit. So that suggests that these intraday markets in Germany are not semi-strong efficient. So there is kind of a public or semi-public information which can be used to make profits. There is a good potential for considerable improvement with better weather forecast, which might actually trigger an arms race in weather forecasting. Admittedly, there is also a lot of potential for better strategies. So I don't claim that this strategy that we have is the best possible. And also, even if you accept the strategy, there are probably more sophisticated ways of learning these parameters. Okay, so you can just think of some reinforcement learning or something like that. So there is actually potential to significantly improve here. And as a third point, liquidity is actually a substantial aspect of all of this. So if you want to trade on the intraday market, you have to take this into account. And if you don't consider this very well, you can make a otherwise profitable trading strategy unprofitable, as we have seen with the kind of impatient strategy. And of course, that also means that day ahead trading is still very attractive, especially for, I would say, less sophisticated traders. Yeah, and that brings me to the end of my talk. I thank you for your attention, and I'm looking forward to your comments.
Thanks a lot for your presentation, David. I think I'll take over the moderating role from Florian for the moment, because it seems he's urgently needed in his role as a young father. So yeah, are there any questions? When there are questions, you might either just put them into the chat, or you may raise your hand and then unmute your microphone.
Hello, this is Emil Kraft from KIT. So take the first question. Thank you, Mr. Wozabal, for the very interesting talk. Very valuable insights. I was just wondering about the out of sample time horizon you have chosen, because I think it contains the change from the mixed pricing scheme and the capacity-based pricing scheme on the reserve market. So I was wondering how the changes in rebab expectations might change the profitability or the validity of the results that you find.
Yeah, so that's actually was a major challenge to find a time horizon where there were no significant changes in regulation, and essentially I would say it's not possible to really do that, especially if you want longer time horizons. So my feeling is it wouldn't change a lot because the rebab doesn't really play a big role here. So, the strategy by design avoids the balancing market because it always tries to kind of put a market order at the end of trading. And therefore, in some sense, for this particular strategy, I mean, it might not be optimal. So you might actually be more accepting towards imbalances. But in that sense, I don't think that it would change a lot because we have very little of these balancing costs. Is my intuition, but maybe you have a different one. Maybe you want to.
Maybe you just need to take care of the current situation, because if I think of the balancing energy market situation like last December, where we reached 5-digit rebab prices frequently, it could be a dangerous risk to take. But yeah.
Okay, yeah. I mean, yes, that's true. Yeah.
And I had another question. It was whether you consider any price making effect in the out of sample evaluation. Like if you are doing trades, are you aware of the order books that you are affecting?
Yes. Yes. So it's fully order book aware in some sense. It's aware of the historical order book. So what I'm saying is I'm putting a trade in, I'm putting an order in actually at a certain point in time in the order book as it existed at that point of time. And then I basically observe the historical order flow and I clear against this historical order flow in a precise way. So this is really a accurate what if analysis. So what would have happened if I would have placed these orders, and that's maybe the crucial point here now, which is in some sense a caveat, of course, but it's hard to really get around that in my opinion. Of course, this assumes that I don't change the order book with my actions. Okay, so what you might expect is that if you have such a trader and you put some orders, that I will not observe the same orders as I have observed historically, so that people would react to what you're doing. And of course, I cannot really measure that. So this is not there in the data, obviously, and I also have no modeling for that. And I think it's of course one of the weaknesses of this kind of counterfactual that we are computing.
Yeah, thank you. I would just agree with that. And yeah, maybe there's options to put this in future work.
Yeah, that might be. Yeah.
So may I direct your attention to the public chat? There is a question there.
Oh, I don't quite know how let me just see that.
It's the chat symbol down at the bottom of the page, but I can read it nevertheless.
Yeah, so that would be great because
okay.
I have this full screen mode here.
Okay, so it says on slide 30, looking at the top chart, cumulative profit, it seems the profit is suffering in winter month. Any idea why? it is coming, or is it coming from a decrease in accuracy of weather forecasts, or might there be another reasons?
Yeah, I have actually no idea is the honest answer. We didn't really, so you see some kind of seasonal effects so I mean, maybe the question is referring to this dip here, or maybe also to this one. So to be honest, I don't know if this is a kind of reoccurring seasonal effect. I think we have too little data for that. So we only have this 1 year. And of course, I mean, it's true that both of these dips, they occur in winters. But to be honest, I don't really know why. I think the forecasting accuracy is, I would say, rather not, but maybe also Thomas Kuppelwieser, who is also there, can say something about that. But my feeling is it's not that, but maybe something else, maybe rather the state of the market.
So
Yeah.
Christoph Weber has a question.
Yeah, thanks for that very nice talk. I really learned a lot, and I would be interested in the two working papers that you mentioned. It looks like they are not available on our website.
Yeah, exactly. So part of the deal is that I anyway have to provide these papers. So I'm happy, obviously, to provide the papers and the slides.
Then I have a question precisely on that slide. So when I look at the total number, in fact, it was also on the other slide of the with the sample statistics, the total profit that you get with your strategy over a year in the when you use actual forecasts, it's 200,000 euro. So yeah, that sounds not very large profit for such a quite elaborate strategy, and compared to the overall market volume. And if not only you would actually trade on with that strategy, but others would start to also follow that strategy. Well, at least if information tends to be processed when it gets available, I would expect that, yeah, you cannot move more than the 200 euros that you have computed closer to the efficiency of the market. Or am I wrong in extrapolating in that way your results?
Yeah, so no, I mean, I completely see your point. So that in some sense sounds, on the one hand side, doesn't sound so bad, because you don't put so much capital in. It's not a very costly, in some sense, also not a very risky strategy, and you earn 200,000 euros. Okay, that's of course not much in the largest scheme of things. So I would expect that. So what I expect is that I view this as a proof of concept. So this particular strategy yields some profits. I think that this does not at all capture all that you can do with this signal. So this basically trades at a specific point in time. If you just restart this strategy like half an hour later, I would expect that you would kind of get a similar amount on top of that. And but you're right. I mean, that there is no evidence for that here in this in this plot. And I think that you can. I would rather see it as a proof of concept, really. So I am not suggesting that this is a perfect strategy, and I'm also not suggesting that it reaps all that you can do, all that you can make out of this signal. And so going forward, I think that this is also, at least for some time, these kind of arbitrage strategies, they also feed themselves in some sense. So if more people would do these kind of trades, you would also have more liquidity in the market, which actually would be a good thing. I mean, I think that might actually help the intraday market, which in some sense currently is really suffering, in my opinion, from this illiquidity. And maybe this could somehow be a self-enforcing thing, at least for a while, for people who compete on these weather forecasts, which would increase the liquidity. And if the liquidity is increased, of course, many of the restrictions that you face here are also lifted in some sense. So a lot of the restrictions are due to limited liquidity. So if the liquidity was much better, especially in early hours of trading, you could earn much more with these kind of strategies. Is my feeling. I don't have any kind of proof of that, but it seems to me.
Oh yeah, very interesting arguments, and indeed there's some. I didn't see these points. On the other hand, perhaps one may argue perhaps the liquidity is that low because, in fact, the value of information updates is very limited because, at least from what I learned from people doing weather forecasts, the improving accuracy remains limited 8 hours ahead of actual delivery.
Yeah. Yeah, okay. So you can, that's true. I mean, I think there is also a lot to be, I mean, that's not my field at all, but I have the feeling that a lot is happening there in this kind of meteorological community. And people are, I think, are getting, this is what we kind of learned from our interactions with Meteorologica, they are getting better at that. And it's also partly because that was, I think, never really so much in the forefront to, for example, predict very accurately wind speeds in certain heights. Of course, you get this out of these weather models, but it was not something which was one of the main things that you were interested in generally. And I think that there has been a lot of progress, and again, this is not at all my field, but I would expect that there will be more in the years to come.
Thank you.
But that's speculative, of course.
So are there any other questions?
See one raised hand.
Yeah.
But
so is that a new question or is it still the old one?
It's a new question, actually.
Right, go ahead.
I don't want to like. Okay, but you have very extensive forecast data in your data set. Do you have a feeling of how often the direction of the forecast error changes? Maybe also your PhD
no.
that you mentioned.
Actually,
elaborate on that.
I don't. Yeah, maybe that's a good idea. Thomas, are you still there?
Yes, I'm still here. I think we analyzed the one direction, if it is right or wrong, but we didn't analyze if the direction is changing from one to the next forecast.
But that maybe it's an interesting point.
I mean, these strategies that are basically getting on new information would suffer very much if it's like changing in direction also the forecast error, because otherwise it's just a matter of how much it will change and not in which direction it will change.
Yeah, so I think that somehow, so we didn't do the analysis of how often it changes, but implicitly, of course, this is captured by this parameter here, by the parameter delta.
Right.
So delta basically says, so I'm willing to trade if the forecast error is, I don't know, something like 2 gigawatt. Okay, and if it's below 2 gigawatt, I will not trade. And of course, that somehow captures this a little bit, because if you forecast, say, 8 hours before delivery, that you have a shortage of 2 gigawatt, it might still be that it's actually a surplus of 2 gigawatt. But kind of tuning this parameter, you kind of trade off the strength of the signal that you require to trade with the frequency that you actually trade. So of course, if you only require a very small signal, you could trade more often in more markets. And if it's a larger signal, you, for one, I mean, it's not only, I think it's not only the flip of the sign, but it's also the magnitude. So if you say it goes from, I don't know, 2 gigawatt shortage to, I don't know, 50 megawatt shortage, you basically also lost all the case for trading in this direction in some sense. So I think the sign change is not very specific. Here it's just that with this delta, you can ensure, if you choose this delta very high, you can ensure that that you only trade on very strong signals. And you can also see that, maybe, let me just see, that for the, no, that's maybe not really true. see that here. Yeah. So, but that maybe is partly kind of captured by that delta. Whereby we didn't do any specific in-depth analysis, I have to say.
Yeah, but thank you. I mean, this threshold is a very smart, like, heuristic or workaround to like handle these kind of uncertainties. So impressive. Yeah. Thank you again.
Okay, thank you.
So we will still have time for 1 or 2 more questions. Yeah, but it seems there are no questions. So yeah, thanks a lot again for your presentation. Great talk. Everybody keep in mind that I think the next talk in this series is in 3 weeks on the 16th of June. And yeah, have a nice evening and bye-bye everyone.